the 10 trillion mistake that changed the world economy. What if I told you that the biggest economic shift in modern history did not happen because of a war, not because of a natural disaster, not because of a market crash, but because of a decision that seemed smart at the time, a decision that looked safe, a decision that felt necessary, a decision that was supposed to protect the economy. But instead it reshaped the entire financial system of the world. Trillions of dollars moved, markets transformed, debt exploded, inflation changed lives, and the rules of money were rewritten, and most people never realized it happened. Stay with me, because by the end of this script, you will understand why prices are rising, why markets behave differently, why governments act the way they do, and why the global economy feels more unstable than ever before. This is not about one country. This is about the entire world. For decades, global economic growth depended on a simple formula: production, trade, innovation, and controlled borrowing. Debt existed, but it was generally limited and manageable. Interest rates were used carefully to balance growth and stability. Then something gradually changed. Central banks around the world began lowering interest rates to stimulate growth. When rates fall, borrowing becomes cheaper. When borrowing becomes cheaper, businesses expand faster, consumers spend more, governments finance projects more easily. At first, this created positive results. Stock markets rose, housing prices increased, startups expanded rapidly, technology companies attracted massive investment. It felt like a golden era of growth. But underneath the surface, a dependency was forming. The economy started relying heavily on cheap money. And when money is extremely cheap for too long, behavior changes. Governments borrow more, corporations take on more leverage, investors take bigger risks, assets become inflated, prices of stocks and real estate began rising not only because of real productivity, but because liquidity was flooding the system. Cheap money created an environment where borrowing felt almost risk-free. And that is where the imbalance began. Over time, global debt reached historic levels. Public debt increased dramatically. Corporate debt expanded. Consumer borrowing grew. Financial markets became highly sensitive to interest rate changes. The system evolved into something new, a liquidity-driven economy. Growth became less about production and more about capital flow. Then came a global shock that forced authorities to act aggressively. To prevent economic collapse, massive financial support was introduced across countries. Governments spent unprecedented amounts. Central banks expanded their balance sheets dramatically. Trillions of dollars entered the global system in a short period of time. This intervention prevented immediate disaster. Markets stabilized. Confidence returned. Economic activity recovered faster than expected. But there was a side effect. When enormous amounts of money are created in a short time, the total supply of currency increases rapidly. And when money supply grows faster than goods and services, inflation follows. At first, inflation seemed temporary, but it wasn't. Prices began rising across industries: energy, food, housing, transportation, manufacturing. Consumers felt it directly. Purchasing power declined. Savings lost value. Central banks then faced a difficult challenge. To control inflation, they had to raise interest rates. But raising interest rates after years of cheap borrowing creates pressure. Debt becomes expensive, loans cost more, housing markets slow down, businesses reduce expansion, investment decreases. The very system that relied on low rates now had to adjust to higher rates. And that adjustment changed everything. Asset prices that had been inflated by cheap credit began stabilizing or declining. Markets became more volatile. Investors reassessed risk. Global capital flows shifted. Emerging economies experienced pressure due to currency fluctuations and higher borrowing costs. Governments with high debt levels faced increased repayment burdens. Corporations dependent on leverage had to restructure strategies. The world entered a new financial phase, not a collapse, but a structural transformation. The 10 trillion impact represents the cumulative effect of prolonged low interest rates, combined with massive liquidity expansion during a global emergency response. It reshaped financial expectations. Investors now pay closer attention to central bank decisions than ever before. Economic growth forecasts are influenced heavily by policy signals. Debt sustainability has become a central topic in global discussions, and inflation awareness has changed how households save and spend. But here is the most important lesson from this shift. When money is too easy for too long, it distorts natural market signals. Interest rates exist for a reason. They regulate risk. They balance borrowing. They prevent overheating. When they remain artificially low for extended periods, markets can inflate beyond sustainable levels. This does not mean borrowing is bad. Debt can be powerful when used responsibly. It can build infrastructure. It can fund innovation. It can support growth during crises. But when debt grows faster than productivity, vulnerability increases. The global economy is now navigating that reality. Countries are focusing on stabilizing inflation. Investors are adapting to a higher rate environment. Governments are reassessing fiscal strategies. Businesses are adjusting capital structures. The system is correcting, not collapsing, correcting. And corrections are often uncomfortable, but they are necessary, because economic cycles always move between expansion and stabilization. The mistake was not malicious. It was gradual. A long period of ultra-low interest rates combined with massive liquidity expansion created dependency. And once dependency forms in financial systems, reversing it requires time and discipline. The 10 trillion shift didn't erase wealth. It redistributed it. It changed investment patterns. It reshaped global power dynamics. It influenced currency strength. It transformed risk perception. And most importantly, it reminded the world that financial stability requires balance, not excess. The future of the global economy will likely focus on more careful borrowing, stronger fiscal responsibility, controlled monetary policy, and greater attention to sustainable growth. Innovation will remain critical. Productivity will remain essential. But debt-driven expansion will likely be more closely monitored, because the world has learned an expensive lesson. Cheap money is powerful, but powerful tools require discipline. The economy is not just numbers on a screen. It affects jobs. It affects families. It affects opportunities. It affects the cost of living. Understanding this shift gives you an advantage, because when you understand how money moves, you understand how the world moves. The 10 trillion mistake was not the end of economic growth. It was a turning point, and turning points define eras. The next decade will reveal how nations adapt to this new reality. Whether they achieve stability through discipline, or face further adjustments through correction. One thing is certain: the global economy will never return to the exact structure it had before this transformation. The rules have changed. The system has evolved. And those who understand the change will be better prepared for the future. This was the 10 trillion shift that changed the world economy. And now you know the story behind it.